I don't know if I'd like this. So let's see. I waited till halftime last night to send Ken this because I didn't know if I wanted to cover up that I was at Ohio State, but turned out well. That was a good risk, I guess. So I have a Bachelor of Science in Welding Engineering. I worked in the automotive and aerospace industries at the beginning of my career and decided I could do better in software. So did software for 25 years. I guess I still do it. I did a lot of video type stuff, video compression, and when you used to have Blockbuster and you wanted to back up your DVDs, I wrote the software that did that, which is, and then moved into like niche government agencies doing video surveillance. So let's see, I've not really worked for, I think, 16 years now. I've been I traded before then, mostly like buy and hold stuff. But I'd say more than 10 years ago, 2013 is when I really like dove into option trading. I dabble, like just as a hobby, I dabble in CNC and 3D printing and design. So go ahead, Ken. So I follow Ken's template, and I think I might have some cart before the horse here, but the one thing that we observed today, I feel like, is just how everything is so personalized. So you hear one person's strategy, you think, well, yeah, that works for them, and you find little, bits and pieces you'd like out of that. And like Brian's, buy, spy, and hold it. And the thing, I guess, about options, it just gives you so much more flexibility in my mind. You take Jack's strategy where he's playing options and he's got very little risk, and then you have Nikki's strategy where you think, oh my gosh, she's got humongous risk, but she's so mechanical that she really doesn't. I mean, statistically, you could have some sort of black swan event, but she actually is so mechanical she can handle those things, that she knows to roll and this happens, and it's the way she just even described it. It's second nature to her how she manages her positions now. So if you want to learn option strategies, I know probably a lot of people here are pretty sophisticated and know it, but for the person that is like, I don't even want to speak up and because I'll, whatever, I don't have a good question or whatever, I just feel like Tasty Trade is just such an incredible resource to just go learn everything, and it helps you determine your own personal, what you're comfortable with. So Ken had on his template asset allocation. So the way you want to, I feel like you want to allocate your assets, and this is on a trading account because like you can have different buckets of money, and I'm strictly focused on like a heavy trading account. So you want to look at your asset allocation in that trading account based on what's going on in volatility. So like I pay attention to what my buying power is, and this is what I try to do with when the VIX is at the different levels. So like I don't follow it like strictly, and it depends again on account size. If you're in a smaller account, you're probably going to be even higher than some of those numbers. But it really comes down to, I treat this as a guideline, not necessarily a rule. So go ahead, Ken, go to the next one. So as I said, very flexible, objectives. I already pretty much covered this. Account size, what your risk profile is kind of how you allocate your assets. And then in that account, you do like 75% what is typically classified as undefined risk, and 25% defined risk strategies, iron condors, verticals, things like that. And then the 75% is like a Nikki strategy, and you don't have to be trading Booking or Netflix or Meta or anything. You could go even smaller and just kind of just do the exact same mechanics she does. You sell your puts and calls, you go one side or the other, get assigned. Some of the smaller stuff that's hard to borrow, you may have to close out of. You close out of it, but you treat it like you didn't, and you just, keep rolling that way. you roll up or down. Go ahead, Ken.
The 75-25 rule, Nikki, do you use that same kind of allocated capital? Put 75% in your unlimited risk and 25% in
No,
your...
I don't even pay attention anymore.
Well, it's not, but don't misunderstand, Ken. I'm not saying 75% of your account. Go to the previous slide. I'm saying
Yeah, yeah.
75%
Of your trading
of what you allocated
Right.
at the VIX level.
Right.
Yeah, yeah.
Okay. To me, those numbers, I'm going to still have
It
to think
sounds like
about that.
she's at 100% of an undefined risk.
Whoa. Okay.
Almost.
Yeah. Whew. Well, yeah.
Yeah.
I mean, of her option buying power, we'll say it that way, because you're assigned, you're getting assigned and then doing cover stuff after that. So my primary focus is on like short strangles, short straddles, iron condors, butterflies, symmetrical, asymmetrical. Like if I get an opinion on where I think something's going, I mean, how often am I right? Am I right 52% of the time, like the market? I don't know. But, and then a lot of, like if I get assigned something, I'll do the wheel strategy and try to get called out on it. And then just basically start over, and you're selling the put. So if it comes down and you're inverted, you just keep rolling as long as you can. And then if you get tired of it, you just, you re-invert it, you pay out a little bit to cover it. But if you look at what you've collected, like over months even, you're in pretty good shape in most cases. So the strategy, lots of rolling out in time, lots of rolling up and down based on what's going on. I tend to go out a little further. I tend to do things, like if something's down to 20 days, I'll roll it out to 45. And that's literally Tasty Trades, like bread and butter. That's what they do. And somebody was asking before where you find the trades. I think you were. I think everybody that pays attention to that network trades all the same stuff, and it's everything that everybody's already mentioned here. And it's usually the highly liquid things, higher volatility index, high open interest, gives you all better opportunity. And go back one more. I do try to close my winning trades at like 20 to 50% and then reestablish. And I decide, is this still worth going into or not? Certain things I tend to have on a lot. So go ahead, next one. Let's see here. So again, a commercial for Tasty Trade. It's just, if you just want to learn that it's free, you don't have to pay anybody. You got professional traders on there. There's enough different personalities. You'll find somebody you like, and you could start. They put their trades on. You start tracking them. You see how to do. It's just like, it's just a really good place to go and learn about something as simple as just doing a covered call or buying. Like, say I want to buy a stock. Instead of buying a stock and you could afford 100 shares of a stock, why not just start selling puts until you get assigned? And so you're almost buying stock at a discount. So if you would have bought the stock and it went down against you, you would have lost that. And even if it goes below what your premium was you collected for the put, you're still better off than if you would have bought it at wherever you decide you were going to go in to begin with. So they've got a comprehensive focus on derivative trading, options, futures, and empowers you, like literally in options, you could define any amount of risk you want to take. Jack strategy, minimal risk. And you're still getting, what you're, the amount of risk you're going to take is typically in proportion to what the amount of reward you're going to get. The other thing about Tasty Trade, you got a CEO of a company that literally, and we're kind of blessed on the West Coast here, you can send him an email like towards the end of the day at night, and I'm convinced he does last in, first out, because usually by the time I get up ready for market open, he's answered the email. So you're literally writing Tom Sosnoff questions and he responds, and I'd say many times my question will end up like, oh, somebody asked me last night, and he'll answer on the air. So it's, it's kind of interesting. There's not many CEOs of billion-dollar companies that are available to just send emails to and get a response. The downside of it is there's so much content, there's a lot of noise, and it's hard to find the signal. So it's like you hear something, because I tend to keep it on like just on my TV and then, hear something I like and you want to go back and try to find it, it's not always easy to do that. Go ahead and go forward, Ken. So just a couple things of my favorite things on there where it gives you like where to go immediately to get start, getting comfortable with everything is they've got a whole learning section, all free on their website. The market measures is almost like every day, I feel like, and that's on YouTube even too, and you can figure out how much to skip because they always have like intros. So I feel like that's almost like every time there's a market measures, I feel like that's worth watching because it's theory and it's all based on their research team. They literally have a research team that runs back tests on all their strategies and will give you the probabilities of everything. I like the style of Liz and Jenny. They're two ex-floor traders that have been doing this for years and just kind of fun to listen to, good personalities, good trade ideas. Confirm and Send is another one where people send in questions, and that's the one that they answer. And that's the one, like if you ask a good question overnight, typically you'll end up on there and they'll use your question on the air. So go ahead, Ken. So, this year I had some health issues. I got a little touch of the lymphoma. So the whole first half of the year, I was trading, but some days I woke up and just didn't feel like doing much, and chemo and radiation aren't a lot of fun. So I was kind of slow in the first half of the year, picked it up in the second half, and I had a pretty good year. I'm not upset about my year at all. And then just again, in closing, if you're interested in learning options at whatever level you are, there's something on there I'm convinced that can help you and it gives you just a lot more opportunity to see how other people are trading.
Thanks. Any questions?
Great.
Okay, great. Scott, let me get you fitted for the
Question here.
Yeah.
What kind of return do you?
Well, that's what I was talking about before. It's so personalized. Like if I said, like, on one account I got over 100%, then you got to defend that, I feel like with options and what your goals are, that's totally achievable.
Like Jack talked about, like an annual basis or anything?
Yeah, like you could take tens. That's why I was really just wondering about how to answer that because I've got several accounts, and if you take I got a 0.5%, is that really representative? I mean, yeah, again, it's so personalized. What are your goals? What account are you focusing on? It's certainly, if you're an active options trader on a small account, like 25,000 or something, 100% is achievable. So, yeah.
Thank you, Tim.
Yeah.
All right, next up, we got Scott. Oh, you got it there, Scott? You want to give a brief background on who you are, Scott?
Sure. Oh, a bit loud.
Look, the microphone is hitting your wire there.
Okay. My name's Scott Hodson, and I'm a trader. I've been investing for about 30 years, and actively trading, 2008, so 16 years, in terms of swing trading, day trading, automated trading. I think I have some intro stuff in here. So Ken just said, hey, can you give a presentation? So I just, instead of talking about me too much, I just figured I'd share a strategy I do. And I call it the lunch money trading strategy. Oh yeah, we can do that 5. Great, thank you. And there's my email address at the bottom. You can always email me and ask questions later if you want. Okay, yeah, before we get into that, so I want to give a shout out to Michael. Say hi to Michael, he's raising a hand. I met him and his friend Mitchell last week. Mitchell was busy trying to get some girls' numbers, so but shout out with Michael. He's studying for the bar, so wish him well. he already knows he's going to be miserable being a lawyer, so he wants to get into trading. And he definitely brought the average age of the group down, so appreciate you guys coming. And so yeah, say hi to him and Mitchell, and they're pretty, they're into the zero DTE trades and stuff, so I'm glad they're here today. So as an introduction, this strategy is called EARN, E-R-N, and it was a strategy mentioned on earlyretirementnow.com, and it's just a site about retiring early and extending your retirement funds and things like that. And they have a concept in this community. They have a concept called return stacking, which is basically if you have a margin account, put 100% in your portfolio in SPY, and then use the rest of your margin for other stuff. And then hopefully those make money, a little bit of money, and you beat the market. You've already, 85% of fund managers don't beat the market. So they have this concept of return stacking. So one of the strategies he does is this EARN strategy, which is profitable and helps him beat the market. I learned about this from a guy named David Sun, and there's Tasty Trade has a Facebook group. It's just different Tasty Trade traders that hang out on Facebook. David spun out, created his own website and podcast called The Trade Busters. He has a free Discord as well, but you have to pass a test to get access to it. So, and the answers are all on his podcast. So if you listen to his episodes of his podcast, it'll be the answers. And if you get answers wrong, he'll even email you back and he'll say, look at episode 8 or look at episode 4 or whatever. So it's kind of a cool community. People know what they're doing. They're pretty smart. They do a lot of research. They have calendar strategies, premium selling strategies, all kinds of different option-based strategies. EARN is a short-term premium selling strategy. And by the way, I'm glad I was referred to as, not I'm glad, I thought it was funny I was referred to him as the extreme premium seller. So maybe, we'll see. By the way, I love the lizards. I remember the lizards, even talking about lizards forever. And I think JSafe and lizards need to spawn and create, J Lizard, Lizard Safe, I don't know. I think that'd be a good combination, so. All right, so here's the strategy from David, as taught by David. And here's where the extremity probably comes in. It's a 1 DTE trade. And he and I and many others use this just on SPX. So we're just selling SPX options. We do it the day before the close. So let's say this Friday, I do it every day. I do it at lunch. That's why I call it lunch money trade. So around 12:45, I have an alarm in my phone set for 12:43 to remind me to do the EARN trade. Because sometimes I forget, or I get busy, or I get distracted. I literally have an alarm that goes off. Or I'm on a golf course, whatever. My alarm goes off. Oh, I stop what I'm doing, pull out my phone, do my EARN trade. You sell a 15 delta put on SPX for the next day. So Friday I sold for Monday. Monday I'll sell for Tuesday, et cetera, et cetera. 15 delta put, 5 delta calls. And for every put you sell 3 calls. So it's a 3-to-1 contract ratio. Some people do this on SPY also. Some people do it on ES. They work just as well. The problem with those is you have assignment risk. So if you don't get out the next day in time, you can get assigned if they go in the money. Other than that, they're pretty good. The exits, now these is where it gets extreme. Your stop loss on your put is 7x. So if you got $3 for your put, you're going to put a stop loss at $21. If you sold your calls for $1, that's 11x. So if you sell them for $1, you're going to get out at $11. Okay? And you let them expire. That's the exit. You either stop out or you expire. Now some of you, your heart sunk to the ground. This is not 3.2% JSafe, losses. These are big. These can be big losses. Now, in defense, one side is losing, the other side's winning, right? So it's not truly, like, the calls are most painful because it's 11x and you have 3 times as many of them. And I'd mitigate that a little bit, I'll talk about that. But here's an example. So let's say you sell, I did this presentation first a couple years ago, so the SPX was around 4,200 So, or 4,300. So you could sell three, I may sell three 4,200 strike puts for tomorrow for $3.05. And then I could, therefore I would sell the 5 delta calls, which are 4,400 strike for $1.10. And then my stop would be on the puts 21.35, and on the calls it'd be $12.10. You put that order resting in your broker. You do not want to watch it, hope, do a mental stop. You will be a deer in a headlight, and you will take a 20, 30x stop if you don't. I've done it, so I guess that's why I'm extreme. Don't do what I did. Okay. Here's how I modified the strategy, more to my insanity, more to my level of comfort. First of all, I don't sell naked. I buy low-cost wings. So I may go 100, 200 points out and buy, I may buy a put. On the puts, I may buy 200 points down for 10 cents. Just to have some black swan risk, like if there's a nuclear war or something happens. I'm going to lose a lot of money, but I'm not going to go broke. Okay. I also don't sell the 5 delta on the calls. I sell the 10 delta, and that gets me a little more premium. Some people in the community, when the IV is really low, these calls are like 80 cents, and they're just, the premium's just not there. I don't like to sell anything less than $1. If I'm gonna be buying wings for a dime or a nickel, I want to at least collect $1. Okay, so. And the 10 delta gives me that. I almost always sell I can get more than $1 for 10 delta. Stop loss orders. So on the overnight, I'll place the stop loss order on the whole spread, not just the short. Because in the morning, that long, that's part of the spread, is going to have some value. Later in the day, however, that thing 200 points out it's not going to be tradable. So at that point, I have to convert my stops to, if I think it might be hit, or has a chance of getting hit, I'll just put the stop, I'll cancel the ordered stop order and put it on the short the short call only, not the long. Because the long's not tradable. It's too far out. And if you have the stop on the whole spread, it will never execute because no one wants to buy or sell you something that far out. I also have this concept of boost. Basically, if I have a stop loss, the next day I double my size. Okay? These almost never, I say almost, have 2 losers in a row. These have an 88% win rate. So there's the sequence risk is very low. There is sequence risk, but they're very low. There was a double stop in December, and I didn't boost that day. I was just holidays. I just didn't want to do the math, I guess. I just did a regular trade. So I didn't boost on that day, but boosting has actually been very profitable, and never had a boosted trade lose on me. But that's extreme, right? You're martingaling, you're doubling. Now, if I lose again, it's over. No more boosting of no more. We're not exponentially growing these trade sizes. It's a one-time thing. Okay, one-time thing only. I don't want to break my account. Here's some other modifications I've done. So I don't do the 3-to-1 contract ratio. I do what's called credit targeting. So on each side, I want to get a certain number of dollars. So for example, and this helps me adapt to the current market volatility regime. So for example, in the David Sun or traditional way, I would sell X puts at 15 delta and 3X calls at 5 delta. In this case, the number of contracts are constant, but my income varies day to day. The way I do it is to say, I want to make $2,400 a day, so I'll sell $1,200 worth of puts and $1,200 worth of calls. But the number of contracts I'm trading is different every day. And right now I'm not trading very many contracts because the volatility is somewhat elevated, so I'm getting good premiums. So I don't have to sell a lot of contracts to get $2,400 a day. The income I receive is constant. And however, on low IV days, I have to sell more contracts than on high IV days. And those stops can be painful because I have a lot of contracts and I collect a very low premium. So on low IV days, I'm a little careful. I'll buy some VIX call butterflies or something to help hedge the fact that in low IV environments, you don't collect a lot of premium and the volatility can shoot up really fast. So here's a back test of kind of the traditional Davidson version of the strategy. It's hard to test it the way I do it because I have this kind of variable contract calculation I do. But this with the I think it was with the this is a $50,000 account has a 24% CAGR, and this is three calls, one put. You could literally do it with $30,000. This would be even higher CAGR because 3 contracts at $100 wide. That's $30,000 of max risk. And if it's portfolio count, you can even do less. You can because you have span margin. You have you don't need to cover. You don't have cash for the full max loss, right? But again, that's risky. But so I just said 50,000 for this, and CAGR is pretty nice. So there is an edge, right? This is from 2021 to yesterday. This is why I got my slides so late and I had to rerun this. The last version I had of this was when this went up to 2023. My results, I started trading this in 2023 around June. So I do have a margin, I do have a portfolio margin account. I use SPX. Like I said earlier, it's cash settled, no assignment risk. I get 60/40 tax treatment, section 1256, tax treatment. For 7 months, I made $20,000. And then for 2024, the strategy, I made $24,000. The last half of the year was bad. 4 of the 6 months were losers. December was rough. And what I found this year is it was like July, August, September, and December were all losers. And basically, you lose money with any premium selling, right? When realized volatility is greater than the expected volatility that you sold your premium for, that's when you lose money, right? So volatility surprised you and surprised the market. And what I found is these periods of low liquidity or like July, August, September, people on vacation. December was bad. It was the last half of December was bad. People were on vacation. So these periods where institutions aren't trading as much, you get a lot more expansion of volatility that's unexpected because it's easier to push the market around by small firms or by big firms that aren't going to have a lot of people, fighting them from moving the market around. And so I think going forward, I want to be a little more careful around these periods of low liquidity or low institutional involvement. Anyway, so that's the return. So what's the return on capital? Because that was one of the things Ken's template had. It's hard to say because I have so many strategies involved in my account. And when I put on a trade, like if I say I want to sell some calls, and I look at my margin required, it'll say almost zero because I have so many short puts already. It's like, yeah, you go ahead and sell calls because you already have so many short puts. You're not adding any more margin to your account. So it's hard to say what is my return on capital, but I would comfortably do this at the least, $80,000 to $100,000 to reach those $20,000 return levels. So about 20%, maybe 30, 80,000. There's some variance. Ooh, running out of time. There's variance on this strategy. I'm out of time, so should I keep going or no? I got like 2 more slides.
You're pushing the envelope.
Yeah.
It's 15 minutes here. I want to give some time for
Yeah.
Jim here too.
There's variance in the community with the 7 DTE hedges, with less data decay. The front side, your short dated contracts have higher gamma, so longer DTE. They have less theta decay and they have less gamma exposure as well. So it's one way to hedge. There's different variants that use 7 DTE strangles to hedge it. Automation someday, but I like to shop the chain myself manually. Build versus buy. There's automation platforms that'll automate this for you if you want. They're all listed there. And there's some active hedging I've been experimenting with, and I don't have time to go through this trade, but this was a nice hedge trade that saved me, about $3,000 last week. And I'm gonna keep doing this. It works for me. I have a job, so I do it at lunch. Like I said, 12:43, my alarm goes off and I start doing it. Takes me 5 minutes to do. So that's it. Any questions?
Thank you, Scott. You want to take one question from the audience? No?
Well, you mentioned section 1243, 60/40 on IRS code. I understand some of that stuff for futures, that also applies to options?
SPX, for SPX, yeah.
Oh, only for SPX or for other things also?
SPX, I think RUT also, VIX,
All index stuff.
pretty much all index stuff, yeah. I would not SPY, not ETFs though, but yeah, indexes.
Anything that doesn't have a stock.
Right. I think it's not SEC regulated very much.
Thanks, Scott. Now, next, Jim. We barely made enough time here for you, Jim.
All right.
So, looks like I'm on.
Don, I think we're doing pretty good. We're almost making it to time. You were saying it would be hard to make it in 15 minutes apiece. So we're doing okay. We need to go through to the questions, but yeah, great. Go ahead, Jim.
Good to roll? Okay. Hi, everybody. Nice being here today. I'm seeing a lot of people I haven't seen in a while. That's really nice. Well, my name is Jim Murkowski, and a little bit about me. I was born and raised in northeastern Pennsylvania. Went to college, got a doctorate degree in mechanical engineering. After I came out on the West Coast and started working, it wasn't long before I started to get interested in real estate. So I did that for quite a long time. There was a lot of times when it didn't seem so much of as an investment as it was as a night job. But then actually that was a really good thing. And then I got interested in the stock market. And I didn't really know what I was doing. You know, you get online and they'll tell you this and they'll tell you that. You know, it takes you time to really find out what's going on. Probably the best thing to do is join a group like this, and then you get to the bottom line a lot faster. Back in 1998, I got a postcard in the mail from a company called VectorVest. And it sounded good, you know, just on that postcard. And it also said that they were having a seminar in Phoenix, you know, like within like a week or two. And I drove over there and I attended their 2-day seminar. I thought it was really fascinating. This is not going to be a tutorial on VectorVest, but I want to mention it as, you know, like Ken was saying, well, like, you know, we want to know the references, what's behind the material we're presenting. And I can tell you that I have an extremely high opinion of that company, because when I started at the turn of the century, you know, like around year 2000, they were very limited in what they did. Of course, I didn't realize that because the first time I was looking at it, but now they've got everything and they're very good at it. You know, long-term trading, prudent investor trading, really good stuff on short-term trading, options. They even have a full retirement investing course. It's a little more expensive, but they even have a coaching room. So, you know, you can learn all about it and you can go into the coaching room and you can see them execute that in real time. Something that I may do, actually. So anyway, I was really technical. I'm kind of a technical person, obviously, because I'm an engineer and I like technical trading. At the time, VectorVest wasn't really into technical trading hardly at all. As a matter of fact, Bart DeLuto, the founder of the company, who is an engineer, graduated from MIT, has developed the phenomenal basis of that company, but he was still more of a fundamentalist, and he used to sometimes laugh when people would point out head and shoulder tops on the curve and things like that. You know, he'd see you're seeing things. But all that changed with that company now they're at the forefront of everything. So I just wanted to give you that background that for anything that I present today, you can go to VectorVest, and in fact that's where I'm getting my information from, and it's pretty awesome, I can tell you. So anyway, I'm basically a TradeStation trader. I program trading strategies. The way I look at it is I do the research and development, and then I will turn the strategy over to the computer for execution. So I can stay out of that loop, because fear and greed really interferes a lot with what you're doing. But just like Brian mentioned and Jack mentioned, the first thing you need to do is control your risk. And if you control your risk, then the profits will come. And the way I can control my risk through program trading is I can put in any kind of exit strategy I want. Stops, profit targets, whatever the case is. And that's the way that I would control my risk, is by programming that risk control right into the strategy. I know what it is and I know how it's going to work. Now, one of my biggest problems in trading and in life in general is lack of consistency. It shows up in my trading. You know, I'll have these humongously big years and then I'll take losses. I'm also an avid horseback riding. It shows up in my riding. You know, I can ride really well one day and one day it looks like real crap, you know. And I see that and I laugh because I know there's like nothing I can do about it. So anyway, let me go forward. So what I wanted to do was, where I'm at right now is this. You know, I came to the conclusions, Ken and I had a conversation recently and I think we're right on the same page, that I decided to turn a lot of my money over to what I guess Michelle was referring to as fixed investments. I thought, you know, I want to be able to invest in things like even like CDs or high interest rate bank accounts. You know, like early last year there was, you know, we were getting 5%. You said I gotta have enough money that if I can make it at 5% into something with no risk of principal, I'll be happy with that. And I don't want to have all these positions and whatever it is on my screen on TradeStation because it's too cluttered. So I send in the largest amount of my money over to US Bank and talk to one of their investment advisors. They have this sort of Wealthscape investor in US Bank. And we talked about putting money into an annuity that was giving me 5%. Treasuries at the time was giving me 5%. I was happy with that. No risk of principal. But then I wanted to allocate a certain amount of money to dividend-paying stocks. It's something that I hadn't got into, but I was starting to get interested in. And all of this is really happening this year. And so I did that, and I'm happy with what I'm doing, and I'm going to show you that today. And in addition, I stumbled on something that I consider to be very interesting and something I've been able to take advantage of that I wanted to pass on to the group here today. One thing about VectorVest, just to get to the bottom line, is that they are not a buy and hold company, you know, even for prudent investors. They'll tell you when to buy, what to buy, and when to sell, no matter what. They have great growth and income courses, for example, and they'll tell you, there's no point in holding on to a stock that's going down and lose 30% for getting a 3.5% dividend. So they know all about that stuff. Okay, so let's move on. And okay, I guess I can use the mouse here. Can we just down arrow here, Ken?
Press the space bar.
Okay. People ask me about presentations and I say, you know, I don't like to present tables, I like to present graphs. They're a lot easier to make sense of, but today you're not going to see that. This is the VectorVest home screen. I just want to point out, you know, that they have a lot of free seminars and a lot of free courses and a lot of free education, just like was mentioned in TOS. Their subscriptions are not that expensive. You can get, you know, like 15-minute delay data type of subscription, or you can get real-time data subscription, which is what I get. And for that, I pay about $1,200 a year. I think it's higher than that in the beginning, but somewhere along the line, they're going to give you a discount. One of their main market timing systems is that color guard dial up at the top. And I have to tell you, I despise that thing. I'm smart enough to know red and green, but I'm not smart enough to know red, yellow, and green. Okay. But it turned out that in the middle of year 2023, they gave another one of their free seminars, and there was a gentleman at the time who was head of VectorVest UK, gave a presentation, and I looked at that and I said, son of a gun, I said, I can program that. But it's not that thing up there. It's something they call their DEW, which stands for Detrended Price Oscillator, Envelope, and a Weighted Moving Average. And they put that together to give buy and sell signals on the overall market. So their main thing, which I can tell you is really important, and they're right, is that, you know, they say you do not buy stocks unless the market's going up. And then, well, how do I know when the market's going up? Well, their market timing systems, one of them which they have, will tell you when the market's going up if you want to believe it. But there's lots of ways you can get buy and sell signals on the overall market. And I'm just telling you this because that concept alone, when I was able to work it into my strategy trading, has helped me enormously. And it's helped me to become far more consistent than I've ever been before. So let's get on with this thing. Okay. Inside of VectorVest, you're going to find a viewer screen, and it's full of watch lists. They've got watch lists for everything. You know, they rank every stock in the that exists, and they can give you a list of their hot stocks. They can give you a list of their dividend-paying stocks. They can give you a list of their high-growth stocks, and this is a list of. They have actually under dividend. They have dividend stocks, and in the subgroups of different. The way they scan, they have monthly dividend payers. And that's what I like. So I went into monthly dividend payers, and I started taking the stocks and ETFs out of that list because it's nice to get paid monthly. And there were some pretty high dividend paying vehicles in here. And what I discovered was there were some really high dividend paying vehicles in here. And here's what they do. There's a company, for short, it's called WiMAX, and I know the screen is a little hard to see. But what they do is they buy or they invest or they do whatever in certain things, and there's a number of them that are pegged to Bitcoin. But I don't want to just talk about Bitcoin. They have other ones as well, and what they do is that they hold these things and they write options on them to make income. And we've heard a lot about options today. So you'll see over here, it says the viewer screen monthly dividend payers. Note the number of high dividend option ETFs. So what we have over here, for example, is the one that I'm in, and I'll speak a little bit more on that because I have a history with it, is Conny, C-O-N-Y. It tracks the Bitcoin Coinbase. MRNY, I'm not too sure what that does. Alta Y might be tracking Alta Beauty. AMDY is tracking AMD. AIYY, I just saw that one last night. It might be artificial intelligence group of stocks. Like, for example, I'm in one right now, an ETF called Chat. And it has 18% of Alphabet, Microsoft, and NVIDIA.
Hold on a second, Jim. Is this too loud for people? Yeah. Can you turn it down a little bit? Let me turn it down.
Yes, do that, because I was having the same problem before.
Yeah. You're standing in front of this mic too. All right, try that. Up to speak.
Okay. Oh, I know that's different.
That's better.
That's good.
Okay.
Okay, very good. Okay, thank you, Ken. I'm good. Okay, so anyway, these are the things that I happen to find over here. You know, that were really high. Now let's take a look. Now, when you take a look at the screen here, it's full of VectorVest proprietary entities. But over here on the right, EY is for earnings yield, and DY is for dividend yield. So from Coney, they're saying that the average dividend yield in the past year is 161%. And if you look at MRNY, 137, 117, 114, and you get down into the 70s and 50s and 40s on these vehicles that they're writing options on in order to earn income, and they're passing that income off as dividends. So I didn't know about all of these, but I saw Coney, and actually there was one called WiMAX as well, but I'm out of WiMAX. So I did invest in Coney, and it went really well. Now we have Bitcoins and some of these vehicles.
Quick interrupt.
Sure.
To let people know, this is using the wheel strategy, and they're so good at it that they basically created an ETF using the wheel. And to create 150% return per year on dividends, wow. So simplifies your work, just basically buy the equity, like what Jim is talking about, and he did it.
Yeah, then let them do the options on it. You know, right, that kind of thing. Okay, so let me go on. So my income stocks and ETFs, the ones that I have, are the ones that's followed. you have Coney, which I mentioned, and MNR is a new one, but that one's paying like 18.6%. Now, I don't know if it's paying 18.6%. I'm saying that the average over the past year was 18.6%. You have to go to a website and find out what that dividend is right now, because these things are not going to remain constant, so I found out. And I don't know how constant they will be when you go from one to the other one. But then I have like BlackRock Capital, that's probably a large cap fund. You notice that this one is sorted by industry. Dr. Vest will tell you that no matter what stocks you buy, you should diversify your holdings by industry as well as other things. Okay, so what do I have? I've got 3 petroleums. Well, no, this one isn't sorted by industry. Just a minute. Yeah, sorted by industry. Okay, so I have this Connie, which is some kind of a specialty thing that's pegged to Bitcoin with the option income. I've got 2 financials, which is Bain Capital and Pennant Park. The ones that are in the market are that's a large cap, and the other ones are probably some kind of bond funds, including the one that Ken gave me, which I really like, which is PHK, which is PIMCO High Yield. And a couple of the others in that category are kind of the same. Altria, we know that's tobacco, MO. I've got 3 petroleums, ETMplex and MMR is one. And then I've got 2 REITs, AGNC and DX. I don't have DX in there yet, but I'm going to get rid of one and put DX in pretty soon. So that's what I've got. So you can see that what my yields are, forgetting about Coney, there's a lot of them that are well over 10%, some are not. I think my average yield I calculated is about 12.2% across everything, because all my position sizes on all of these are about the same. So now what I want to do is say, hey, I want this kind of a thing to pay my expenses. And so I have a spreadsheet at home where I look at what all the kind of money on it that I have allocated, what my dividends are going to be, what my major expenses are going to be, which is going to be, home insurance, car insurance, exorbitant property taxes, and double exorbitant horse fees. Okay, so anyway, so when I see all that's covered, fine, I can settle down, and then I can do everything that I'm doing already. I'm just doing it with a lot less money as far as my strategy trading is concerned, and I'm really comfortable with that. So that's what I'm doing. Some of the growth stocks I've held, and I'm going to tell you, if you have VectorVest, I can be a lot more confident about stocks that I buy. Then I'll tell you that when I show you a chart later. But right now, I've got like MCore. There's a Bitcoin that doesn't pay any dividend. CHAT is the one that contains the AI stocks. ELF is Elta Beauty, which is always recommended, and it's got a pullback. I can't remember what YEXT is. It was highly recommended when I ran it through VectorVest. Their statistics were good on it, therefore I bought it, and it's more of a low price stock, 653. IGM is an aerospace sector kind of ETF, and Grab, it's a financial, and I can't remember, but it looked to be rated pretty well, plus the fact that it was a very low price stock, and I figure I don't have a big position in it, I'm going to buy that one. I don't have stops in any of that, by the way. Okay, so this is the basic curve that you're going to get, or the basic chart. If you type a symbol into VectorVest into a watch list and then chart it, you're going to get something that looks like this. Now you can make these charts look differently, but I want to bring up this one. It's really important because for VectorVest, they will look at the price pattern and the earnings pattern. And the nice thing about VectorVest is they take all these things like growth rates and earnings and everything else, and they have proprietary ways of consolidating them down into one number. So like, for example, they have, if I showed you the chart there, the table that I have, they have something called the GPE. Well, the GPE is just the inverse of the PEG ratio. So instead of looking for small numbers of PEG ratio, if you use the GPE, you're looking for high numbers if you do sorts and things like that. What they want, okay, is a price chart that goes from lower left to upper right, and they want the earnings, EPS in the blue envelope, going from lower left to upper right. That's the premier, highly rated stock that will be defined in VectorVest. Is the chart this way. Now, those are for my growth stocks. As a matter of fact, this is EME. This was the first one I had. And you could see that. And the other thing that's nice about this is that I'm sure that we all get on the web, we're on the internet, if we do anything financial, pretty soon all the articles start showing up about income stocks and growth stocks and this and that. Well, if you read these articles, they'll give you, what they'll do is they'll give you the story. The one thing this doesn't do is it doesn't give you the story. I mean, I don't know why EMA is so good, but if I read something that's recommended, they'll tell me why. But they won't give me this information. So I say now, be careful, don't take these tips, these stock tips. Well, if you have VectorVest, you can throw all these tips into a watch list and plot them. And when you get charts like this, hey, I've got the price pattern and the earnings, and the article gave me the story. Okay, that's the way I look at it. And if it comes to an income-producing stock, you're often not going to see that lower left to upper right, because what it's doing is it's taking those earnings and it's distributing them to the shareholders. So I want to see something that's pretty stable and just tracking horizontally around the screen, but I want to see that earnings picture anyway. And that's the way that I look at it, and that's the way I select my growth stocks and my income stocks. Let's go further here. Like, for example, here, this is Bain Capital Management. It goes back 5 years. Well, back in 2020, everything crashed, but pretty much, it's kind of like horizontal. And it's got a dividend yield that's about 9.9% right now. So if it wants to shovel those out, on income and, its dividends, that's okay with me. I don't need to see big growth here on an income stock. But I want to see this. See? I see good earnings all the way. Yeah, it's fallen off a little bit over here, but I'm not worried about that. But I want to see this, and I don't care if it's a skyrocket up there. Now, where I go for my dividend information is I go to marketchameleon.com. It's free, and all I have to do is type a symbol in the upper right-hand corner. It will give me the dividend history, and it will give me the projected dividend the announcements for the projected dividends coming up in the future. And that's what this does. And this is a monthly payer, and down in the lower pane, for all those that have been paid, you can see it's going month by month. But the thing that happened this month was that they cut the dividend from, when I started investing like 4 or 5 months ago, it was about $1.04 per share. The stock price might have been about 14 bucks. If you pencil that through, you might get something close to about 96 to 100% dividend yield. And all of a sudden they cut it. They projected it to be zero, but when they paid it, which is yesterday, they recorded on Wednesday, I did get like 83 cents a share. But from now on, they're projecting zero. Now, maybe they'll change that next month. But right now, I'm thinking about dumping this thing. So where do I stand? Because the Bitcoins have come down, and this one has come down a lot. Let me see if I have the chart here. Yeah, see, this is Coney right here. And you can see on the right, I've taken this loss. So what happened? Well, it turns out that I made $1.04 a share, then I made $1.10 a share, and then they said it was going to be 37 cents a share, but when it came out, it was $2.02 a share, and then another $1.10 a share, and now it's 83 cents a share. So if I take all the dividends over if I was, I can't remember, it's 4 or 5 months. If I'm in it for 4%, if I add up all the money I made in dividends and subtract the loss that I've taken recently, I'm still up 15% in 5 months, or 4 months. And if I was in there for the previous month, I'm at 20% for 5 months. So I'm still good because of this horrendous dividend that they're doing by doing the wheel strategy that Ken mentioned. Let me just go up here a little bit. Okay, so you can see in the middle pane, they're all zeros, and I'm kind of nervous about that. On the one hand, on the other hand, since the price has fallen so low and it's on support, I might not dump it, but I might say, okay, well, we think that we're bullish on the market now because of Trump and the statements they're making about Bitcoin. Maybe I'll just hold it to see if I can make some of that loss back, knowing that I'm not going to get a dividend in the future. But maybe they'll change that. Maybe they'll start making money on their options. But there's alternatives, and that's what I wanted to talk to you about. So if we go down here, from that list of monthly dividend payers, I just extracted like the top 8. And I ran them through Market Chameleon to get the recent dividend payout amount. And this is in dollars per share. And they have the current price is in the second column. And if we go over here, that if I take that price and if I take the dividend payout and divide it by the price and multiply by 1,200, it's 100 to get the percent and 12 because they're paying once a month for the year. Then I'm going to get the yearly yields that you see in the fourth column. The bottom one is 48% and the top one is 130%. Now it could be that I'll sell that Coney and I might distribute the money between AIYY and MSTY. MSTY tracks the stock MSTR, which I think is isn't that an AI stock or a semiconductor?
MicroStrategy.
Bitcoin. They hold 400,000 Bitcoin.
Okay.
MicroStrategy.
So, I might do that. But the question is, why would I do that? Well, this is Coney, it's down. MNRY, but this is also down. Okay, so maybe I'll just jump over here because now they've both taken losses, really. They're both consolidating. But MRNY is paying a dividend, but Coney is not. And the other thing I notice, and I'm glad I just remembered this guy, but you notice the high volume on the right on that consolidation? To me, that's accumulation. I don't know if anybody ever read a book by, I think it's Richard Arms. And he talked about stocks that go square. I'll never forget that, that's why I know him. But anyway, if you're on a bottom on support and you see high volume and that stock isn't moving, that means because it's being accumulated. In other words, the buyers, the sellers can't push the price down anymore because it's being bought up. And if you're up at resistance and you get a high volume and you get flat, that means that the buyers can't push it up more because everybody's selling into it. So I think this is a very good pattern. So I might move maybe half the money into MRNY and maybe half the money into AIYY, which is a similar condition with high volume on the right-hand side. And I'll just go with that because they're really high dividend pairs right now. They're over 100%. And it's only because they're writing options on it. So if I keep going, this is Misty. This is CRSH. I like this. Volume is okay, but I don't see that cluster at the end that makes me feel more confident. This one is YBit. It's tracking some Bitcoin. And what else do we have? We have NVIDIA. So there's NVDY. So this is a vehicle they have that's tracking NVIDIA. And they're writing options on that, and we have a similar pattern. All this stuff has really taken a beating recently. And that's basically it. I'm gonna diversify across. I'm gonna keep all these dividend vehicles that I have, but I'll probably get rid of Coney, and I'll probably buy 2 of the high ones that I've seen now that still have positive dividend announcements coming up in the future. And I'm not gonna bet the ranch on these stocks, but they'll probably be just an equal position of every other thing that I have, averaging out to now. Maybe that'll drive my. If I get a couple of these, it'll drive my my average dividend yield up to maybe 17–18% a year. And without taking too much risk because I'm spread out over a number of positions that I have. And that's all I have to present today. If there's any questions, Michelle?
You may have answered this, but you don't reinvest any of the dividends, do you? You take all the dividends in cash?
Right now, I'm moving it all out. Oh, one more thing. Yeah, I'm moving. My advisor at US Bank is the one that sort of controls the movement of the money. I like to get out of that. But at the end of the month, any dividends that have been paid in there, he will move it out to another account that I have in US Bank. And when that account gets over to, say, 15–20,000, I'll take the balance of that money and I'll send it to an online bank, which is called Western Alliance Bank. It's currently paying about 4.25%. So I just keep earning these little bits of money on all the money. And And then I know, okay, so my car insurance is paid, now I'll go play games with my strategy trading. But we'll just do it with a smaller amount of money. And that's it. Yes?
Quick question. You mentioned AMDY and NVDY. Are they single stock real strategies?
You want to repeat those? Can you
I
hear
didn't
that?
quite get it. I have a little hearing
AMDY
issue.
and NVDY.
So
And what about those?
are they single stock
Yes.
strategies? I.e., are they just trading, is AMDY only trading AMD, NVDY only trading the NVIDIA stock?
I assume so because they pegged it to the symbol.
So what they peg it to the symbol, but what they're doing a lot of the times are they're buying deep in the money calls and they're writing calls against it. So they're basically doing something like the wheel strategy with all options. It's a really amazing vehicle that they're doing. And the one that he mentioned there, I don't know if anybody saw, but I'm moving more and more money into PHK. It pays a 1% dividend per month. And it's a nice income stream. Very, very nice income stream.
How is the price stability?
Can't hear you.
How is the price stability of PHK?
Pretty good. It's pretty flat.
Yeah,
And
pretty
right
flat.
now, it's actually low, and it's where I entered the last time, the last tranche. So I'm going to be entering in even more. But, you know, your J-Safe is pretty damn good though, man. But this is another way, it's another way of generating an income.
I'm gathering other ideas to.
Yeah, yeah, yeah. All right.
You know, and it'd be nice if people do get into this, you found out more information, if you could sort of feed it through the system here and we could all take advantage of it. I would like to hear it. So anyway, that's
Yeah.
what I have.
Great. Okay, thanks. Thanks, Jim. Hey, one other thing here. Richard Vanoy teaches, you want to give a quick shot here?
Hi, Richard Van Oy. Whoa, wow. Yeah, my background is 20 years in the Naval Submarine Force and then 35 years teaching college electronics and programming at the associate's and the bachelor's level. So I've been a programmer for all of those years. I got here, I love easy language. There are some definite problems with that for me. I want to teach easy language to beginners. Okay, that's what I want to do. Right now, our club, the club that has the programmers in this group, meets on the first and the third Tuesday of each month at 6 p.m. on a Zoom room that I have. I'd like to reserve the second and fourth Tuesdays from 6 to 8 p.m. for a beginner's class for easy language programmers. If you want to join that class, write down roboticsprofessor.com. That's because when I was teaching both electronics and programming, guess what? When you put those two together, what do you got? You got a robot. So I picked up the name Robotics Professor and I've kept that ever since then. So if you write to roboticsprofessor@gmail.com, I'll put you on the list. You'll become one of our students, and then 2 Tuesdays a month, I will teach beginners easy language, okay? That's what I want to do. If you're interested in trading, you want to write your own strategy, you want to write your own indicator, you want to do something that you want to do, I'll teach you how to do that. Okay, thank you.
Is it roboticsprofessor.com?
Yes. Thank you, everyone. I hope everybody had a good